G'day folks, welcome back to another update for gold and silver. Now they've both appreciated in the last few hours of trade, or last couple of days of trade. Has gold broken into a new long position, and has silver continued a bearish downtrend? So I'll look into the charts in a minute. Don't forget to hit that like and subscribe button to support the channel. Also, we are now including a weekly video series, Pete's Investing Plus One, as part of Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. So if you're new to trading or an experienced trader but would like to fine tune your knowledge, then this Plus One weekly series should help you gain confidence. Last week's Plus One video talked about how to set up your chart, and I'll speak with a newbie trader who asks basic questions that you may also have. Looking at the outlook for gold as of today, April 10, the price surge. Gold prices have reached record highs, surpassing $3,000 per ounce, driven by escalating geopolitical tensions, including ongoing conflicts and trade disputes. The central bank demand, increased purchases by central banks aiming to diversify reserves away from the US dollar, have bolstered gold's appeal. And in terms of the market outlook, analysts project continued growth, with forecasts suggesting prices could reach $3,500 by 2026. For silver, the industrial demand. Silver's significant industrial applications, particularly in green technologies like solar panels and electric vehicles, contribute to its bullish outlook. Market volatility. Despite positive demand factors, silver has experienced price volatility due to global economic uncertainties and trade tensions. And price forecasts. Some analysts anticipate silver prices could reach about $35, potentially reaching $40 in the near term. So first, looking at gold, we look at the long-term trends. So we've got the monthly, the weekly and the daily. You can see the price is well above the moving averages on the monthly, giving us a nice bullish momentum. There's no CCI forward drawn on the monthly, but you can easily tell that's a bullish move. On the weekly, however, we've got this bearish divergence. Lower highs on the CCI versus higher highs on the price. And we're expecting that to pull back and hit our minimum range. Now, if I drew a Fibonacci on that minimum range, we could actually draw two bearish divergence here. The first one being up until that peak there on the CCI and that peak on the price. And if we pull the Fibonacci back to that level, you can see there that first one, if I just zoom in a minute, you can see that first pullback hit that 23-38% minimum range. That was the first retrace back there. Now, if we draw another Fibonacci from, you can see there's another bearish divergence there. So if we draw another Fibonacci from where it is at the moment, assuming it pulls back from there and we take it back to that significant low, you can see there it's just about to touch that 23%. Now, if it falls further, again, this is on the weekly, so a long-term play, we just take it back to the previous low and that'll be our next target. So we take it one step at a time. At the moment, it is a bit of a bearish move on the CCI, even though the price is making new highs. And at the moment, we've got a bullish candle. This could actually pull back any time. So this would actually go higher and the CCI could keep dropping. That'll still remain as a bearish divergence. So we'll just keep an eye on that. We'll take it one day at a time. As soon as that starts pulling back and hitting our initial 23% target, then we start measuring the wider Fibonacci retraces. That's on the weekly. On the daily, likewise, we've had some other, you can see there, bearish divergence in various segments. And the latest one here, again, if it was to draw a Fibonacci retrace from that high, we would have, so that's where the divergence started at that point there. So you take it back to that significant low. And you can see there it's already hit our 23-38% target range on the daily. So that's what I mean. And it's actually bouncing out of that at the moment. But notice the CCI is also bouncing into that moving average range, so giving us a somewhat neutral positioning. So I wouldn't be going long. If you're trading on the hourly, I wouldn't be going long yet. I'd like to see this break higher than that moving average on the CCI. The price is already broken above the moving average, so just be careful. Don't go long too early. I'd like to see this break above that moving average range to show some bullish move and more bullish trades to be taken. Now, if we go on the intraday chart, if you're trading on the 1 hour time frame or the smaller time frames, and I'm demonstrating here on the 1 hour, you see there you would have taken short positions based on the daily from that position there, and that's where you would have taken short positions on the daily. Now, notice here we've got a bullish divergence. So let me go first to the back testing, and what I've got here is the stop loss approach, and here I've got the average down approach. So again, just to understand how I'm trading these strategies, you just reference the +1 video series that I'm putting out on a weekly basis, which is helps you better understand the insight of these tradings. Now, in terms of so you can see there, I started the back test here when that daily broke below the moving average range on the CCI, and the stop loss approach up until today, it's actually broken to the downside. But notice you've got the bullish divergence here versus lower lows on the price. So ideally, you would have taken note of that as when you saw a bullish divergence, and you would have got out of the trade somewhere at that point there on both the stop loss approach and the average down approach. So if you got out at that point there when the CCI broke into that moving average range after that bullish divergence, on the stop loss approach, you would have generated approximately $640 if you were trading a $10 gold contract, or approximately $2,100 based on the average down approach. So again, just always pay attention to these bullish or bearish divergences that go against your direction. So for silver, we've got the monthly still bullish on the price, but notice the CCI is touching that moving average band, giving us a somewhat weakening signal in terms of bullishness. So we might see a bit of a retrace continue to the downside. So the monthly, I would call that a potential neutral positioning. On the weekly, it's already broken below the moving averages of both the price and the CCI. If I zoom in for a moment, you can see there we had another bearish divergence here versus the price, and that was initially hit our target range here. That was a 23.38% level. Again, if we drew that to the point before the divergence started, that would have gone back to that would have been going to that level there. But you can see there, it depends where you draw the Fibonacci, that would have been actually to that level. And if you drew it to that level, that still hit the 23% level. Even to that low, still broke to the 23% level. So you take it to the significant low, and that still hit it there. Now, at the moment, we're in a bearish momentum on the weekly, and on the daily, that's also broken to the downside quite strongly the last, few days previous to the last couple of days, last week. And at the moment, we've had a bit of a retrace of a couple of nice bullish moves, and it's hitting that moving average range on the CCI. So if you're going short during this period on the intraday chart or the daily, you'd be taking your profits if you're going short, because that could potentially keep rising from there. So if we go onto the intraday chart, again, you would have taken short positions based on the daily if you're trading on the hourly in this example. And here again, you had another bullish divergence. Now, before our last video, it projected a very slight bullish move here with a bullish divergence. But we put in a target range of the 23% target. Now that failed because why? The price kept falling, but the CCI kept rising. So if that happens, we just basically readjust it and we keep following. So in this case, it dropped to that level, and the CCI kept rising, and we take it to that level. So as long as that keeps rising and it keeps falling, we just extend the trend line of the divergence. And in this case, it then eventually did bounce. Now, I don't trade these, so you would not have gone long during that little bullish divergence projected. You just extend the trend line to see where it does eventually turn. Now, in this case, let me just delete that so we don't confuse it with anything else. So what we look at now is, once you start seeing a solid pullback according to that bullish move, you can see there it's actually broken through that 38% range. Hovered, consolidated in there for a while, broke down, then it broke, and it's actually broken higher now. So it may possibly reach that 50% at least in the coming days, but at the moment it's resting on this, what was previously support, now a resistance line at 30.81. But notice the CCI is still rising, so we might see further upside in the short term. But again, I wouldn't be going long. I'd like to see the daily break higher as well to be more positive about going long. Now, if we go to the back testing, and here I've got it starting from that period back there when it broke below the CCI on the daily. Again, similar to gold, you would have paid attention to this bullish divergence and taken your profits. So here we had a stop loss approach. Now in here it's actually broken. If you're going there, it's actually broken below our baseline. So if your baseline was 100,000, I'm just using it as a starting point, only to allow for any currency trading like Japanese yen, for example, that shows it in the tens of thousands. So you could use it as a, if they break below your starting point, you're in the negative there. Whereas the average down approach, because you averaged down a few times there and you closed out your position at that point there after that bullish divergence started happening and it hit your target range, you would have been in the negative on the stop loss approach and you would have been positive approximately 6,100 on the average down approach. Now again, with the average down approach and the stop loss approach, I'll be introducing a money management video in the +1 Pete's Investing +1 video series, and that'll come up in the next few days. So look out for that. So again, look out for Pete's Investing +1 videos to help navigate chart analysis and improve your profits. Thanks, and talk to you in our next video.